Did you know that global markets experienced a significant drop in response to slowing U.S. economic growth? Let's dive into what this means for investors and the world economy. In today's video, we'll explore the recent panic in global markets triggered by indicators of slowing growth in the United States. It's a pretty big deal, and it's shaking things up more than you might think. So stick around as we unpack this situation and how it could impact your investments. Presentation of problem/challenge. Now, let's get into the meat of it. The U.S. economy, which is a huge driver for global growth, has shown signs of slowing down, and investors are getting pretty anxious about it. This drop in growth is causing ripples across the markets, leading to sell-offs and volatility. Investors are worried that if the U.S. economy takes a hit, the effects will cascade through the global economy, affecting everything from trade to investment flows. We're seeing markets react swiftly, and it's not just the stock market, commodities and currencies are feeling the heat too. So, what's really behind this slowdown? Exploration/development. Let's break it down a bit further. There are several key factors at play here. First up, we have inflation rates. Prices for goods and services have been climbing, and that's putting pressure on consumers' wallets. When people have to spend more on essentials, they have less to invest or spend on discretionary items, which can slow economic growth. Then, we have interest rates. The Federal Reserve has been adjusting rates in response to inflation, and higher interest rates can discourage borrowing and spending. That means businesses are less likely to invest in growth, and consumers might hold off on making big purchases. Lastly, we can't ignore consumer spending trends. If people start feeling less confident about their financial future, they're likely to cut back on spending even more. All these factors are interlinked, and together they create a challenging environment for the economy, impacting markets worldwide. Climax/key moment. Now, let's talk about the climax of this market reaction. Picture this: one day, investors wake up to disappointing economic data, and suddenly, panic sets in. Markets plummet within hours as traders rush to sell off stocks. The volatility is palpable, and stock prices swing wildly, reflecting the uncertainty and fear among investors. It's a classic case of herd mentality, where everyone starts reacting to the same information, amplifying the market's response. Major indices experience their worst days in months, sending shockwaves through global trading floors. This peak moment highlights just how interconnected our global markets are and how quickly sentiment can shift when economic conditions change. Conclusion/summary. So, to recap what we've discussed today, the slowdown in U.S. growth is causing significant concern among investors, affecting markets around the world. We've looked at the factors contributing to this slowdown, including inflation, interest rates, and consumer spending. And we've witnessed how these elements can lead to rapid market reactions, showcasing the volatility we're currently facing. Call to action, CTA. If you found this analysis helpful, be sure to check out our other videos on economic trends and market insights, and let us know your thoughts in the comments. What do you think about the current market situation? Your feedback is always appreciated, and we love hearing from you. Thanks for watching, and stay tuned for more updates.